Hello everyone, and thank you for joining us this afternoon at this Your Overseas Home webinar. My name is Rosie and I'm a senior copywriter here at Your Overseas Home. Today we'll be chatting with John Dyking from Chase Buchanan about your financial considerations to think about when moving to Spain. It's great to see so many of you with us today, whether you are watching live or on demand. Today we'll open the floor up to John. He'll share his presentation and then we'll have time for questions. If you do have any as we go along, feel free to type them into the questions tab on the right-hand side of your screen. We do hope to answer as many of your questions as we can today, but don't worry if we don't get round to yours, as any unanswered questions will be forwarded to John and the team. So thank you for joining me today, John. It's nice to see you.
It's obviously nice to see you as well, and welcome everyone to the call.
Lovely. So just to start off, John, could you please tell us a little bit more about yourself and what Chase Buchanan does?
Absolutely. So Chase Buchanan is a highly regulated wealth management company. So we specialize in advising expatriates on their financial planning, and our aim is to provide clear and simple, jargon-free advice. So we want to provide trusted advice and make it simple for our clients. And we want to provide the best level of service in the industry, which means that we have the right regulations, the right structure, and the right people. And to help it by myself, I'm Swedish. I've lived in Spain for 22 years. I live in the Malaga region and I've worked in finance for over 20 years. And I've helped thousands of expats to navigate the financial journey when they move to Spain, especially from the UK. So I'd like to tell you a bit about our services as well. So we focus mainly on helping people with their investments, financial planning, retirement planning, pension transfers, advice on their savings, etc. And we also have people in the business that can deal with US nationals, which are this highly regulated business when you deal with US nationality, so we can do that as well. And we have some other solutions as well we can offer, but the main ones we focus on is helping people with investment savings and pensions. If we look at our office locations, so we are headquartered in Europe, but we have offices across the world. So you can see our offices here on the screen. In Spain, we have 3 office locations. So we are in Marbella, Tenerife, and Javia in Alicante.
Lovely, thank you. And in terms of the tax considerations for anyone looking to move down to Spain from the UK, can you tell us a little bit more about that?
Yeah, I think there are quite a few points to consider because Spain, the tax regulations here are very different from the ones in the UK. So normally what works well in the UK from a functional tax planning point of view doesn't work well here. So you need to then focus on tax residency, when you become a tax resident, what are your fiscal obligations in Spain when you move down here, what taxes you need to pay. You need to consider income tax, wealth tax, there's something called national solidarity tax, inheritance and gift taxes. There's a report called Model 720. There are pitfalls to avoid as well. You got to watch out for certain things when you move down. It's important to be aware of certain things I'll talk about today. And we also have a checklist that we can provide people that want to move down just to help them avoid these pitfalls. So I'm gonna, in the coming slides, I'd like to talk you through these different areas.
Okay. And at what point would you be considered a tax resident in Spain? And
So
what
it's
would...
hot.
Sorry.
So,
No, go ahead.
no, sorry.
I was just going to say, once you are considered a tax resident, what would be your main fiscal obligations?
Yeah, so it's quite simple. Like the general rule is that you become a Spanish tax resident when you've spent at least 183 days in Spain in a calendar year, because the Spanish tax year is the same as a calendar year. It goes from the 1st of Jan to the 31st of December. Now, there are some other rules which may deem you to be a Spanish tax resident as well. So if you have your center of economic interest in Spain, for example, someone comes down here to work, they may be deemed a tax resident for that reason anyway. Even if they don't spend 183 days, they may need to report income in Spain. And also, if you have a spouse that lives in Spain or dependent children, then Spanish tax authorities will by default deem you to be a tax resident as well. So this can be relevant, for example, for someone that works for an oil company and spends many weeks abroad on an oil platform, and the spouse is at home with the children. So that person could be deemed a tax resident in Spain, even if they spend less than 183 days in Spain.
Okay, fabulous. And how does income tax work? Does it matter if you're working for a company remotely? Obviously, so if I was working remotely in Spain, it would be for a foreign company.
Yeah. So if you have I mean, as soon as you become tax resident in Spain, then you'll be liable for Spanish tax on any income you get from your worldwide earnings. So whether you have work income in Spain, if your visa allows it, obviously you got to be careful, or whether you have income from investments or pensions income, that's fully taxable here when you become a tax resident here. You also have capital gains tax in Spain on your assets. And in certain regions, you could be liable for wealth tax. So it used to be across the whole of Spain, but some regions have effectively eliminated wealth tax. We'll talk about that later as well. And then you got to be careful to report certain foreign assets to Spanish authorities. So we'll talk about that later as well. And then you got to be careful with inheritance tax as well, because Spanish rules are quite different from ones in the UK in particular. And with financial planning, you can actually avoid inheritance tax liability. So it's always good to plan these things ahead well in advance.
Yeah, definitely. Okay, thanks. And how are you taxed on savings and capital gains?
Yeah, sorry, do you mind going to the next slide?
Yes, sorry.
Rosie, thanks. Yeah, no worries. I'm just gonna, before we go into that, just to tell you a bit more about the income tax. So the income tax is split into general income, and which has a specific tax band, and then you have savings income, which includes capital gains, which is a different tax band, which we'll look at later. And Spain is split up into 17 different tax regions, and it gets a bit complex. So, if you live in Andalusia, for example, you don't have quite the same tax obligations as when you live in Valencia region, or if you live in Catalonia,
Right.
for example. So if you have income, that general income from work pensions, then half of your income is taxed at state rates and half is taxed at local rates. And then you just add up the two. And generally, the rates go from about 90 to 47%, but they could go above 50% for high income earners in certain regions. So it's important to know that income for 2024, for example, for this calendar year, it will be payable by the 30th of June 2025. So you do have lots of time to report the income for this year. And people coming from the UK, they're used to having a personal allowance of about £12,000 roughly. The personal allowance generally here in Spain is about 5,550. It varies a little bit by regions, and for people that have very low income, there may be some additional allowances. So if they have like disabilities, things like that, there could be some extra allowances for that. And allowances tend to go up a little bit as well with age. So when you get over the age of 65 and 75, then there tends to be an extra allowance of about 1,200 for each 10 years, roughly.
Okay, great.
Sorry, I'll answer your question about the savings tax now.
Thanks.
So when you have income from savings, which in Spain, this means interest from bank accounts, dividends from shares, investments, collective funds, or capital gains from the sale of investments or the sale of properties, like buy-to-let properties, for example, then you tax on this band, and it's per person. So the first 6,000 in gains is taxed at 19%. So if you have a joint asset that you get interest from, or you sell, then the gain or the interest will be taxed, for example, up to 12,000 will be 19% because you jointly held asset, because this is a personal tax band. and then between 6 and 50,000 is taxed at 21%, and so on. So this is actually a pretty good band. It's not as high as the general rates. So in Spain, it tends to be more efficient to structure income so it comes from investments if possible. It's much lower than getting income from other sources. So that's something that we can help people and see if we can restructure certain things to get this tax advantage when possible when we advise the clients.
Okay, and what are the other wealth-related taxes that buyers should be aware of?
Yeah, so as I mentioned earlier, you used to pay wealth tax all over Spain previously, but over the last few years, many different regions have decided to eliminate wealth tax because many people see it as an unfair tax because it's taxing assets you've been taxed on already at some point. So it's been eliminated recently in Andalusia, Madrid, Murcia, and the Balearics. So the way this works is that in the regions where this has not been eliminated, then you generally taxed on wealth which exceeds 700,000 euros. And you tend to have a main residence allowance as well of 300,000 euros. And this is per person. So if you live in one of those regions and you're, let's say, a couple and you have some assets between you and you have a joint property. So let's say you have a joint property worth 600,000 and you have other assets worth 1.4 million and you got 2 million between you, all those assets can be exempt from wealth tax. But you got to be mindful that some regions like the Valencia region, for example, and Catalonia, they have lower limits for wealth tax. It's not been eliminated, so assets from 500,000 per person will attract wealth tax. It's very important to look at your assets before you move down, see if you need to take any actions, if you need to restructure something to be more efficient here in Spain to reduce wealth tax. There are ways to reduce it. And when you are in scope for wealth tax, then you pay tax on a sliding scale, which goes up to 3.5% for amounts that exceed 10.7 million. So for people that have very large assets, this is a really important area to look at before you move down. So you need to find out, is wealth tax applicable in the region you're going to? And if it is, what can be done to reduce it? Okay. That's really what I wanted to say about wealth tax.
Okay, thanks. And is it just those 4 areas that don't have a wealth tax in place?
Those are 4 areas where expats can be focused on. There may be some other areas as well which are not as popular with wealth tax, but these are the main ones that we tend to deal with, linked to our clients. Okay,
fab, thank you. And something that comes up quite a lot, can you explain what the National Solidarity Tax is and the Modelo 720?
Yeah, absolutely. So when certain regions started eliminating wealth tax, there's been a bit of a conflict with central government in Madrid, which is left-wing. They didn't agree that this wealth tax was being eliminated in certain regions. So this happened I think it's about 1.5 to 2 years ago. They imposed a new tax called the solidarity tax on large fortunes. And it's effectively another wealth tax, but it kicks in at higher thresholds. So when you have assets above 3 million euros, then you are liable for this wealth tax, but you do have the general exemption of 700,000 on top. So effectively, you need to have 3.7 million per person in essence to be bound by this. And you still get a property allowance, just like for wealth tax, for 300,000. So you can have actually 4 million in assets if you include the main home. So in the regions where you are still liable for wealth tax, like for example the Valencia region, then there's the provisions in place in the law to avoid if you pay the same tax twice. So you're not going to pay both the wealth tax and solidarity tax. So when you do your solidarity tax return, then you get credit for the wealth tax that you paid already, and you just pay the difference. So this solidarity tax applies across Spain. So as I said earlier, it's a way for the central government to try to offset the eliminations of the wealth tax. So in Andalusia, for example, the wealth tax has been eliminated, but this tax is still applicable because it's countrywide. So anyone in Andalusia who has more than 3 million in assets would need to look at this, and it could be liable for wealth tax after the deduct exempt amounts. That's really what I wanted to say about the severity tax.
Lovely.
You asked me about the Modelo 720 as well, which we can see on the screen. So Modelo 720 is a report of assets abroad. So anyone who lives in Spain and has assets abroad worth more than 50,000 euros needs to complete this report to inform Spanish tax authorities that they have these assets. The assets are divided up by 3 different categories. So it's property, cash, and investments. So as soon as any of these 3 categories exceeds 50,000 in total, then it triggers this reporting requirement. So some people have tried to be clever and divide it up, like they got 10 bank accounts abroad with 5,000 euro equivalent each in each account. But that doesn't really work, because you add up all the account balances and it's 50,000 still. So you got to do the report. So it's a bit of extra burden on people that have lots of assets scattered around abroad. And when we advise people, we try to just make things simple. So if we can simplify things and have less assets abroad, less reportable assets, it just makes things a bit easier for tax reporting. There are certain investments we can set up that help people reduce the admin burden and tax burden on investments. And to give an example of that is we can set up something called Spanish compliant investment bonds. And the ones that we use are fully authorized by Spanish authorities. They're very tax efficient, but also because they are authorized, it means that the investment company does the reporting on behalf of the client. So there's no need for a client to do this Modelo 720 report for that certain investment. That's really what I wanted to say about that.
Thank you. Sorry, my mic was off. And what advice can you give regarding inheritance tax?
Yeah, so this is an area where the regulations differ a lot from the ones in the UK. So people coming from the UK got used to talking about an estate, and generally any assets exceeding £325,000 are liable for a 40% tax. So each person has like this null rate ban of 325,000, and the excess is taxed 40%. And then you can have an extra null rate ban in the UK linked to your main residence, etc. But even if you use up the null rate bans, you can't have more than 500,000 in assets which are exempt. Whilst in Spain, this is actually an area where in many regions the rules are much more favorable here than they are in the UK, because in Andalusia, the Balearics, Canary Islands, Galicia, Madrid, Murcia, and Valencia, inheritance tax has been eliminated or virtually eliminated between close family members, and it's almost unlimited. We don't talk about 500,000, so it can be exempt for very, very large inheritance as well. So this is a really positive development we've seen in the last few years. I think you should be aware that inheritance tax in Spain can only be applied if one of 2 conditions are met. One is that it's a Spanish resident beneficiary that receives inheritance, and the other condition is that it's a Spanish asset. So if it's a Spanish property or cash in a Spanish bank, then that will always be assessed with Spanish inheritance tax. We call this the gift tax. Sorry, before we move on, we talk about gift tax as well, because the gift tax regulations are very, very similar to inheritance tax regulations. So the tax rates and the exemptions, etc., are pretty much the same for lifetime gifts as they are for inheritance. I guess one of the key differences is that if you make a lifetime gift, to get the exemptions, you need to go to notary and make it an official gift, because otherwise you could be liable for gift tax, even for gifts between close family members. So you got to be really careful with that. And I think a few things to mention there before we move on is that Unmarried partners, which are called like pareja de hecho in Spain, which is like civil partners in the UK. Some regions, they are recognized as being fully equal to married people, but not all regions. But for example, in Valencia and Andalusia, it's just the same as married. You got to be a bit careful in other regions. There may be some differences between pareja de hecho and married spouses in terms of tax liabilities. And the tax rates go from 7 to 34% for people that don't have a close family relationship, and they can be multiplied as well for very distant family or friends. So, and the inheritance tax depends on the amounts, the kinship, and things like that. So it can get quite high when you have no family to pass on assets to, and if you want to pass to a friend, or if you want to pass to stepchildren, for example, which is quite common nowadays. People tend to have, it's more and more common to have second marriages and kids from a previous relationship. And it's very important to plan ahead if this is your case, because stepchildren are generally very disadvantaged in Spain, and something that we can perhaps look at the next slide, which illustrates that point. Thanks. So what you see here is the four categories of beneficiaries. You can see that group one is the main category which gets most exemptions of children under 21. Group two is other children, and this is all natural children, so stepchildren are not in group two. But you got grandchildren as well, parents, grandparents, spouses, civil partners in Andalusia and Valencia. Then you got so groups one and two, they tend to get most exemptions, and they can be really, really good. But it's kind of like a line between two, and then if you go down to three and four, they tend to not get any exemptions and allowances at all. So in-laws, stepchildren, cousins, nieces, nephews, uncles, aunties, brothers, siblings as well, like they don't get any benefits. So it's very important to plan ahead if that's your situation. If you want to leave assets to categories three and four, then it's best to have a look at it.
Yeah, good to know. Thank you. And what are some pitfalls to avoid?
So some of the common pitfalls we see is that people don't realize that their tax-efficient investments in the UK are not tax-efficient here in Spain. People come here with ISAs. ISAs are tax-free investments in the UK. They're not recognized in Spain. So any investments you have in the ISA, the growth you have in those investments will be taxable in Spain when you cash them, and then the dividends received from the ISAs or interest income will be fully taxable in Spain, even if it's received inside the ISA. Premium bonds are taxable here. If people have offshore bonds, like for example Channel Islands bonds, they're not Spanish compliant, and it means that the tax shelter, the tax wrapper is not recognized, so you will not get the tax benefit you thought you had, and the investments will be taxable anyway. Especially if those bonds are based in tax havens, they could get a very punitive tax treatment here in Spain. You got to be really careful, and this is like one of the main areas people ask about when they move down, is like, what happens when I sell my main home? How can I avoid to be taxed in Spain on it? Because most people have been living in their main home for a long time before they come down. Normally people come down, most of the times I speak, come down to retire or retire early, so they had a main home in the UK for a long time, and when they sell it, with property prices having gone up over the years, there will be a very large capital gain, which if you sell it as your main home, you get an exemption in the UK. There's no tax to pay on a home sale. But if you're not careful with your timing of the move, you could be fully taxable in Spain on the entire capital gain on the sale of your main home. And they wouldn't just tax you for the gain from the date you came here. They would tax you from the gain since you bought the place. So that's why it's important to plan ahead. We can assist people with that. I would say that the general rule that works for most people is to try to come down in the second half of the year, try to sell your property in the second half of the year. So if someone sells, let's say in July this year, and they obviously need to get the right type of visa. Normally, I recommend to sell first, and then you make sure you apply for the visa. Don't apply too early because you can get, you can stress out in case the sale doesn't fall through. Sorry, in case it does fall through. So normally you need to have sold and then come down and spend less than 183 days in Spain in the year that you sell the property, which means you can become a tax resident in the following year. So if someone sells in July this year and comes down shortly after the sale and they haven't spent much time in Spain before, and they just spend maybe like less than 6 months in Spain, less than 183 days, then they can become tax residents from the 1st of January next year. And the home sale and other transactions you undertake before you become a tax resident will not be liable for tax here. You will not need to report the sale in Spain. You will not need to put on the property on the Modelo 720, etc. Because when you become a Spanish tax resident, all those transactions are already completed. I just mentioned property as an example because it tends to be the main asset people have, but the other main asset is pensions. Most people build up personal pensions, work pensions, even people that work, for example, for some of them, as even civil servants, etc., like NHS workers, they tend to have pensions they can draw a lump sum from. It can be important to draw that lump sum at the right time. Ideally, you draw it as a UK tax resident. Even if you don't need it, you should still draw it because it's tax-free. You release that amount of money with no tax to pay. Because if you were to draw a lump sum as a Spanish tax resident, you'd be fully taxable on it here. So even if you don't need it, then it's still worth taking it. You could just reinvest it in something else and you washed out the tax bill on that money. Normally, you should consider selling your ISAs, getting rid of them, get the tax-free growth or dividends, and then you can just do something else here that works in Spain. And that's what we can help out. We can offer solutions which are very tax efficient in Spain. We don't have ISAs. We have other things that we can set up that are compliant and authorized here in Spain that works to provide you with tax efficient income and tax efficient growth, and also help people with estate planning. Like how can you pass on assets in a tax efficient way to your family if someone moves down here and maybe they got kids in the UK, stepchildren in the UK, and we can really help out and make it a very simple and easy transition and make sure that people, that the new beneficiaries, don't get hammered with inheritance tax when this happens.
Yeah, thanks, John. Some really good things to think about there. Just while we're on it, so you can take out a tax-free lump sum in the UK on your pension. If you didn't do that and you just got it as normal, you fill in the form with the UK government and then you get it in Spain, how is that then taxed?
Well, you would then be added to your general income for the year that you receive the lump sum. So the income tax rates, as we said earlier, they generally go from 19 to 47%. It depends a bit on the region. There are some slight variations. So a lump sum will normally go up to higher rates, especially if it's a large pension. So it could mean that some of your pension lump sum will be taxed at 35, 40, 45%.
Right.
Which can be fully avoided by taking a lump sum in the UK before you come down. Obviously, you gotta be over 55 normally to do it. Yeah. So if someone wants to move down really early and work, they don't really have the option to do that. But if you're over 55, you should seriously consider it.
Okay, thanks. Good to know. And finally, to wrap up, can you summarise why people should seek professional financial advice moving to Spain, and let us know if there is a best time to do it?
Yeah, absolutely. So we have a checklist that we're happy to send out if anyone's interested with some of the points you should consider before you move down. You should review your savings first of all. You should speak to someone like myself, and I'm happy to just have a specific chat with you and see what's important to you financially. How does your assets look like? avoid specific pitfalls for yourself. Because I think I've been quite generic on this call, but there are other things that you need to be aware about, which I can talk with people specifically about. So you need to review your savings, investments, UK pensions, understand what the differences are when you come down to Spain. So I can help people understand if you leave things as they are status quo, these will be your approximate tax liabilities. How can we improve it for you? What can we do? What options can we offer you to restructure your assets, take certain actions, and you can reduce your Spanish tax bill for your income. You can reduce it for growing your wealth, and you can reduce tax on inheritance as well. So we look at the holistic financial planning. We're not just looking at how to reduce your tax today, but we're looking at the longer-term financial planning where we help people and design solutions. You should another pitfall, as we said earlier, be careful when you sell your main residence, you're not taxed in Spain. So as I said earlier, you got to avoid spending 183 days or more in the year that you sell the property. So you got to spend less than 183 days in the tax year that you sell your property before you move to Spain. And this is 183 days accumulated. So if someone comes down here for holidays, those days are taken into account for the 183-day rule. So it's not consecutive days; it's total days in a tax year. And you should also seek advice on estate planning. As I said earlier, especially for people that have stepchildren, they should be very careful because stepchildren could be, for inheritances of hundreds of thousands of euros. We talk about percentages of tax. It could be like 20, 30, 40%. So it's quite significant. Lots of tax savings can be made by just planning ahead and restructuring your assets. And just be mindful that Spanish and the UK systems are very, very different, but there are professionals that are locally based here in Spain, such as Chase Buchanan, that understand both the Spanish side of things and the UK side of things, and we can then provide holistic advice, make sure that you cover from all the angles.
Lovely, thank you. Let me just check where we're up to. Just to let you know, we have ran out of time. However, we will stay a little bit longer because we've got a lot of questions coming in for John. So thanks, John. So here at Your Overseas Home, we definitely recommend Chase Buchanan. They truly make tax simple, which goes along with their tagline, trusted advice made simple. And John, did you want to tell us about your QR code?
Yeah, absolutely. So I just hope everyone has joined the call, enjoyed it. Hopefully you've taken something away from this call. There is no one size fits it all. This is why our business is very, very personal. We offer a very personal service, and I do offer a free initial consultation, which you can book very easily. So I do prompt you to, if you have a phone next to you, you may just want to pick it up and just turn on the camera and scan the QR code that you see on the screen. That enables you to book a meeting straight into my diary, right now. And a video call is set up for us to have a chat about your circumstances, about your objectives, what's important for you, what are you planning to go down, what areas you're looking at, etc. And we can see how we can help you out. So there's absolutely no obligation to proceed with any solutions. I just want to see how we can help you out. Hopefully we can tell you something that's going to help you in your journey and your transition to move to Spain. So feel free to book yourself in. I've been really happy to speak with you. 100% sure that I can tell you something that you can take away that's going to help you with your financial planning before you come down to Spain. So hopefully I'll hear from you soon. Don't hesitate. I'm very, very keen to speak to as many people as possible and help as many people that listen to this webinar as possible.
Fab, thank you, John. We do recommend that you do reach out. Sorry, would you mind popping yourself on mute just a second? Getting a bit of an echo. We do recommend you reach out, especially as John will then be able to give you specialised advice based on your requirements. So I Well, we'll stay about 10 more minutes if that's okay with you, John, and I'll run through a few questions. So, first up, we've got Nicholas. Are capital gains tax payable to the Spanish government if you sell your home in the UK? Is there a time of year to do this or to avoid paying it?
Yeah. So it's like I just mentioned, if you sell your property as a Spanish resident, then you'll be taxed here on the whole game. So you have to sell as a UK tax resident, and normally it means that you sell in the tax year before you become a tax resident in Spain. So when you're coming down, like once normally you sell your UK property first, and then you get the visas come down, and then you make sure that you come down at the right time so that you don't overstay your days in Spain in the tax year that you come down. So right now is a really good point in time in the year to do that kind of planning because we're in June. So if someone wants to move down pretty soon, and if you're sitting, you want to take some action, and if you are putting your house on the market right now and it happens to sell in July, for example, you can come down shortly after July. As soon as you get the visa, assuming you haven't spent any time in Spain, you'd be spending less than 193 days in Spain this year. If you come sometime, let's say mid-July, late July, and it means that you will not be taxed on that sale until, well, you won't be taxed at all because you would have spent less than 6 months in Spain for this year, and you become a tax resident in Spain from the 1st of January 2025. So all your income from the 1st of January 25, all gains, taxable gains from investment sales or buy-to-let property sales, etc., will be taxable only from that point, from the day that you become a tax resident, not from when you were a non-tax resident in Spain in the previous year.
Okay, fab, thank you. I'm not entirely sure if I understand this question, but I'm going to ask you anyway. Brian has asked, in simple terms, if I buy a property in Spain and obtain a non-lucrative visa, will I pay more total tax in Spain and UK added together compared to if I only visited and rented under the 90-day rule?
So that's a question I unfortunately can't answer without knowing the wider circumstances. So it depends on what income you're getting, what your sources are. Is it work income, investment income, pension income? Are you do you have assets that you need to sell? Are you expecting capital gains, etc.? So I think generally Spain can be a high tax country if you don't plan ahead. But if you use the right tax allowances, if you use the right tax structures, plan ahead, make sure you get the inheritance tax allowances. You can look at what areas in Spain you're going to move to, especially if you have large amounts of assets. You can try to avoid areas where there's a lot of tax on wealth. So that's something that I'm happy to spend some time with yourself, get to know you, understand your situation a bit more, what your objectives are, what need for income you have, and we can design a plan for you to get tax efficient income. We can decide, what sources we should draw from. If you have a pension, if you have investments, we can draw from one source or the other to make it more tax efficient. It's something that I'm happy to spend some time with you and discuss with no obligation. So feel free to book in a time with myself, and I'm happy to talk through it.
Thanks, John. We've had a couple of questions about Irish passports moving to Spain. So the first one's from Alex. I assume it's talking about his partner. Him and his partner both have Irish passports, but were residents in the UK. Could we live in Spain but keep UK residency for tax purposes? Our income is not from Spain.
It's a really good question. I do get this one a lot as well. So I think we need to separate tax residency from visas. It's two different issues, right? So if you're Irish, you have an Irish passport. It just means you're an EU national. You have freedom of movement in Europe and Spain as well. So you can just easily come down and get something called residencia. So you don't need a visa, and it's both for you with Irish passports can come down. Or if a couple has one Irish citizen and the other one is British, then normally the Irish citizen registers for residencia first, and then the British partner just piggybacks on that residency. It's really easy as well. So even if you can obtain rights to live in Spain really easy with your e-passport, you would still become a tax resident in Spain if you spend more than 183 days in any tax year. But it does mean that, if you get, and also if you do get the residencia, that would kind of like assume that you're gonna live in Spain. So I think it's gonna be, they may challenge you to say if you don't do tax return, but you register as resident in Spain, and they can ask why you're not submitting tax return. So you like to be challenged on that. Just be mindful. The tax residency rule, the main one is when you spend 183 days in the tax year, that's when they would expect you to become a tax resident.
Okay, fab. Thanks. We've got a great question from Jim here. He's given me some extra information, so it's split across 3 questions. Just give me 2 secs. Jim is retired in the USA. He is 77 years old. He's a British citizen with a military disability income that's tax-free. How would that work if I moved to Spain? He's looking to buy a yacht, license it in Spain, and buy healthcare.
So military pensions are civil servant pensions that, under the double taxation agreement, are exempt for tax in Spain. So if it's a British military pension, you'll be taxed only in the UK and not in Spain. And that income would be taken into account. So when you have other income top, it may move you to marginal tax rates, but you're not getting taxed in Spain on military pension. Sorry, did that cover the question?
I think so. Yeah. Would you be taxed on his pension?
So if it's a UK military pension, no, that it will not be taxable here under the double taxation agreement between the UK and Spain. It will be exempt from Spanish tax, but not from UK tax and source.
Okay, fab. I will just confirm to everyone this webinar is being recorded, and it will be uploaded in about an hour if you wanted to catch the beginning or skip back at some points. Okay, I will do a couple more questions if that's all right with you, John.
Absolutely. Go ahead.
Lovely. Okay, Paul asks, my primary income comes from the letting of commercial property in the UK, which I do not manage directly. I'm not sure if these are classified as real estate or business assets.
So this depends on if is the commercial property inside a limited company, or is it owned directly by him or his family? So it's something that I think we will need to have a chat and see how that be taxed. We will need to look at, are these assets worth a lot? Are you moving to an area of wealth tax? This would have implications of wealth tax. Whether it's in company or whether it's your private name, there'll be different tax implications on the letting income, etc. So this is something that warrants a private financial discussion, which I do encourage you to book a video call with myself, and I'm happy to have a chat. And I think we can probably cover your questions once we know a bit more about your situation.
Lovely, thank you. And I'll just do one more. We've got a question from Claire. Does Spain have equivalent investments such as UK ISAs?
Right. So there is nothing that is exactly like an ISA here. The most similar thing that we can offer is something called a Spanish compliant investment bond, which is a structure that allows your income and your capital to grow tax-free inside a tax shelter. The difference is that when you want an income, then it's going to be some tax payable, so it's not completely tax-free like an ISA. But on the other hand, there's an ISA allowance each year, so you can't put more than the ISA allowance, which used to be around £20,000. I'm sure it's still the case, but there's no such maximum amount, so you can put a very large lump sum into a Spanish finance bond, and that money can be growing tax-free from day one. So you don't need to build it up with annual allowances. So this can actually be something really good for people that are used to having ISAs, but they don't really work here, but we can set up this kind of structure.
Okay, fab. Thank you so much. That is about all we've got time for today. Thank you so much, John, for sharing your knowledge with us. And thank you to all of our listeners for joining today. We strongly recommend you get in touch with John and directly to discuss your requirements in detail. You can still scan the QR code, you just use your camera on your phone. We will be in touch with their details shortly if you would prefer to email. Before we finish, I would like to invite you to leave us a review on Trustpilot if you did find this webinar helpful. We'll be very glad to hear. Thanks again, John. Thanks for staying a little later, and good luck to everyone with their Spain property hunts.
So much for obviously thanks to Patty as well in the background doing all the tech work, and thanks everyone who joined in.
Lovely.
And I hope to hear back from you soon.
Thank you. Goodbye.
Bye everyone.